Hey guys, it is Julie here with JT.Wealth. In today's video, we are going through our Dividend Investing Series. So let's get into it. All right, guys, welcome back and thank you so much for being here. Like I said, today we are going through our Dividend Investing Series. So in today's video, we are going to take a look at our current holdings in our dividend portfolio and their performance thus far. Plus, we are going to compare our performance to the S&P 500. After that, we're going to go through a few pieces of advice when it comes to dividend investing. So for anyone who is watching that might be new to our Dividend Investing Series, the whole point of this series is investing $50 per week into a portfolio with M1 Finance that we've designed around solid dividend paying stocks. The goal of this is in the long term to create a portfolio that we can receive passive income upwards of $2,000 a month from. And if you're looking to start your own M1 portfolio, check out the link down below in our description where you will get a $10 bonus for signing up and funding your account. And we are not doing this series alone. Also participating are our YouTube friends, Sam from My Financial Friend and Logan from Logan Fisher. So Sam is contributing $100 per week into his dividend portfolio and Logan is contributing $25 a week to his. So we have a variety of investment price points for anyone looking to start their investing journey. And just before we get into the holdings of our portfolio, this is just your reminder that if you enjoy this video, make sure you give it a big thumbs up and let us know your thoughts down below in the comments. All right, now let's take a look at our M1 Finance dividend portfolio. Now, I am happy to report that we are seeing a bit more green this week as our current value is up at $830.38. That represents a gain of 9.6%, coming from $34.33 in market gain and $6.47 in earned dividends. Our dividend portfolio currently has 12 different stocks in it, and those include AT&T, Invesco's S&P 500 High Dividend Low Volatility Fund, Coca-Cola, Realty Income Corp, Navient, Walgreens Boots Alliance, Cisco Systems, AbbVie, 3M, Shaw Communications, JP Morgan Chase, and Pfizer. Our top performers out of those right now are Navient, JP Morgan Chase, and AbbVie, with our worst performers being AT&T, Cisco Systems, and Shaw Communications. But of course, as a long-term investment, we are not too worried about any stocks that are underperforming right now because we have a very long time frame for them to recover and see some growth. Now let's see how our investment portfolio has performed compared to the S&P 500 over the same time period. So as a reminder, our current return right now is at 9.6% on our portfolio. And we started this portfolio 16 weeks ago, so about 4 months. Now comparing that to the S&P 500 during the same time frame, so going August 12th to now, their return was 4.45%. So very happy to report that we have actually beat the S&P 500, and not only did we beat it, we've about doubled their return. So big cheers to that. And now I just want to quickly cover what Investopedia calls the 6 rules for successful dividend investing. The number 1 rule is choosing quality over quantity. And one of the most important considerations for investors when choosing investments is the dividend yield. The higher the yield, the better the return, but the numbers can be deceptive. If the stock's current payout level is not sustainable over the long term, those market-beating dividends can quickly dry up. REITs are a good example of how fluctuations in the market can directly affect dividend payouts. And if you caught our last dividend investing video, you might recall how I explained that dividend yield is relative to the stock's price, so this can fluctuate every single day. Selecting an investment that offers more stability may mean sacrificing a certain amount of yield in the short term, but the result may be more favorable, particularly for investors who prefer a buy and hold approach. The income generated by lower risk dividend stocks may be less, but it's likely to be more reliable over time. The second rule is to stick with established companies. The stock market moves in cycles, and it has a tendency to repeat itself now and then. When choosing dividend investments, there's no better measuring stick than a stock's past performance. Specifically, investors should be targeting those companies that have earned dividend aristocrat status. These are established companies that have increased their dividend payouts to investors consistently over the previous 25 years. Their brands are easily recognizable, and they generate a steady flow of cash with a high likelihood of continuing to do so in the future. And of course, you can take that one step further and look for dividend kings, who have been paying and increasing their dividends every year for over 50 years. Rule number 3 is don't forget to look for some growth potential. While newer companies can pay out some impressive dividends, investors shouldn't be jumping on the bandwagon without doing their research. Aside from looking at the past and present returns, it's also important to look at the company's future potential to increase its dividend payouts. This is the primary difference between growth investing and value investing. With growth investing, rather than focusing on what the stock is trading for currently, you would look at the long-term outlook for growth to gauge how profitable it would be from a dividend standpoint. Rule number 4 is to be mindful of the payout ratio, as a company's dividend payout ratio can reveal how safe the investment is. This ratio tells investors not only how much is being paid out to shareholders, but also how much income the company can retain. If you come across a high-yield dividend stock, but the company is paying out a substantial percentage of its income to investors, that's a sign that you need to tread cautiously. If the company were to see its income stream reduced, the amount of dividends you're receiving would go on the chopping block. Rule number 5 is to make sure that you mix it up. There is a strong argument to be made for concentrating assets on a handful of stocks or targeting a specific sector of the market. If the companies or industries you've zeroed in on have an exceptional track record, that bodes well for your future dividend earnings. On the other hand, that can be problematic during a market downturn. Spreading assets out over multiple dividend-paying investments adds diversity to your holdings, and it allows you to minimize risk. When dividends are reduced in one area, the loss may not be felt as deeply when the rest of your portfolio continues to perform. And finally, rule number 6 is know when to hold and know when to fold. Investing guru Warren Buffett firmly believes in taking the long view when it comes to investing, but like any smart investor, he knows when to cut his losses. With dividend stocks, there's a fine line between waiting for the investment to pay off and hanging on too long. This is a particularly easy mistake to make when purchasing stocks that on the surface appear to be an excellent value. The problem occurs when the company fails to deliver regarding growth. Being able to recognize when a stock is sinking is vital, but you also have to know when to act on it and when to sit tight. So adhering to some of those guidelines will help you maximize the potential of your dividend investing portfolio. But let me know your dividend investing strategy down below. I always love hearing from you guys, so please leave a comment. Let me know some of your dividend paying stocks that you love and what investment plan you have in place. If you made it all the way to the end of the video here, make sure to give us a big thumbs up that you are subscribed and check out some of the other parts of our dividend investing series. Thank you guys so much for watching. I hope you have a wonderful day, and cheers.